Hello, fellow Rebel Capitalists. Hope you're well. So, gold is getting very close to an all time high today. I think it did hit an all time high intraday yesterday, over $3,900 an ounce. So, we have to start asking the question, is this a bubble? Should you start selling your gold immediately? Is this 2011 all over again? Let's dive into that topic right now. First and foremost, we'll do a screen share here. And if any of you know where Josh is, let me know. I'm assuming most of you will say that he's swiping on Tinder, maybe Grindr, who knows. But he's MIA, guys, he's MIA. So I'm going to have to do the screen share all by myself. But let's get into it. And we're going to start with, let's go over here. Gold's record-breaking rally. Who's keeping it going? So the punchline here is it's all about central banks and it's all about capital flows into ETFs. So, and I think this is a really kind of a cool breakdown of the pie chart here. Let me see if I can zoom in for you guys. All right, global gold demand by sector, according to Metals Focus. This goes back to 2016. And the red is jewelry fabrication. Net physical investments, kind of the peach, beigeish color. Green, net central bank buying. I wish they'd give like aggregate totals or nominal totals. It's like with the percentages, I wish I could see like how much they're actually buying, because it's just kind of robbing Peter to pay Paul here. Look, it goes down to 40% with the jewelers, but is that a net decline? I mean, did they actually buy less, or is it just a lower percentage because everyone else is buying more, right? So I think they go through that here. Annual net purchases of gold central banks have exceeded 1,000 metric tons each year since 2022. So this is not something that's just happened recently. This has been happening for, call it, 3 years. Developing countries are seeking diversified dollar after Western sanctions. Okay, so let's be specific here. Are the countries doing this? Are the central banks doing this? Absolutely. Are the corporations within the countries doing that? Probably not. Probably not. Because they have a different reason for holding treasuries, as an example. For them, the dollar represents utility, where for the central banks, the dollar represents counterparty risk. So it's a different dynamic there, much different dynamic. But it is unequivocally true that the central bank, I don't know if they're dumping treasuries or just more so buying a lot more gold, and then the price of gold has gone up, because you see everyone talking about, oh my gosh, now all of a sudden the central banks have more gold reserves than they have treasury reserves. Okay, but is that just because the price of gold went up? And are you calculating that in ounces? Or are you calculating that in the overall value? And the same thing with the treasuries, right? Are you just calculating that based on the value as to where they were in 2020? Obviously, the values have gone down because the interest rates have gone up. So I'm a little suspicious of that. But it is unequivocal that these central banks are buying a lot more gold, even in ounces, than they have in the past. I mean, wouldn't you? I mean, for heaven's sakes, you don't have to deal with the FX risk that banks have, like commercial banks, because they have to match up assets and liabilities, right? So if they have a dollar liability, they have to have a dollar asset. Whereas with a central bank, well, they can have negative equity. They can't go bust. So if they have a dollar asset or a euro asset or a yen, or excuse me, if they have a dollar liability or a yen liability, euro liability, yuan liability, they don't have to match that up with the same dollar asset or yuan asset or yen asset or whatever. They can go ahead and match that up with a different denomination asset, and that includes gold, Bitcoin, anything like that. So, okay, now let's get over to the jeweler section of this. As far as demand for gold jewelry, the main source of physical demand, fell 14%. See, this is getting close to the punchline here, guys. We're getting close to the punchline. So just once again here, demand for gold jewelry a main source of physical demand, fell 14%, the lowest since the cerveza sickness. High prices spurred the decline. Maybe, or maybe the retail people are just selling more. Check this out. Are people still buying small gold bars and coins? There has been a major shift in appetite for different product in retail investment market, but total purchases in the sector remain robust. But they're not really increasing. Investment demand for gold bars rose 10% in 2024. Okay, was it done in 2025? While coin buying fell 31%. I think that's very, very important to distinguish between those two. Because a lot of my friends in the business, they own gold companies and they own gold coin dealers, and they're saying their spreads are super, super, super tight. And what that tells you is that as far as the retail goes, there's net selling. There's net selling, because if there was net buying, then you would expect those premiums to really go up. And we're seeing the opposite of that. So now let's go over to a gold chart. So gold slips from peak or record peak on caution from Fed's Logan. I don't know if that had anything to do with it, but basically this gal came out, Lori Logan, and said, oh, we got to worry about further rate cuts. Maybe we shouldn't do this. We got to worry about inflation, as the labor market is just completely collapsing right in front of her face. And by the way, why do I always bring that up? I think it's important. Let me just go back and check on the screen share real quick, and I'll reveal exactly what I'm referring to. If we go over to this chart of the 1970s that I always like to use, this red line is the CPI. So you can see it going up, up, up. Yes, stagflation, but then you see it go down, 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 down. The exact same thing here in 1980. So why do we see this red line going down? Like, especially in the 1970s, why do we see this red line going down? Because right here, you had a recession. And right here at this peak, you had the unemployment rate spike. In other words, the labor market just, boom, fell out of bed. So it's very, I can't find a time in US history, even in the 1970s, where the unemployment rate spikes, the labor market just crashes, and you have an acceleration of inflation. I can't find a time where you don't have disinflation. Like even right here in the 1970s, this is 75, going into 76. Look at this. From 74 to 77, you had disinflation. Now, was the inflation rate still high? Yes, but it was going down this whole time. It was not going up. And why? Because you had a recession right here. Unemployment rate spikes. So if you've got a deteriorating unemployment, or excuse me, if you have a deteriorating labor market, which we obviously do, I mean, look at the ADP numbers yesterday, then you shouldn't really worry about a reacceleration. Now, are prices too high, and are prices increasing at a rate that is higher than I would like to see? Absolutely. Absolutely they are. But it doesn't necessarily mean that we should be worried about if we drop 25 basis points on Fed funds, which, by the way, they don't control the curve anyway, and they don't control interest rates. Then it's not like we're just going to see inflation rip higher, assuming that the labor market is deteriorating. I always like to point that out because a lot of people get confused about that one because they haven't really done the research. Where were we here? Okay, get back to CNBC. So gold prices fell 1% today. Spot gold was down 0.5. Okay, we got that. The dollar index went a little lower. I think that's because just the odds of the Fed cutting maybe even 50 basis points next meeting are increasing, at least in the minds of a lot of people. And I think that's why you're seeing a little bit of a decline in the dollar, all about interest rate differentials. But I don't know if that's really impacting gold one way or the other. Now let's go over to something that's really important. This is a chart of the GDXJ, so the ETF of the junior miners. Check out an intraday chart. So we had this big sell-off at the open, going to just call it around 10 o'clock. And I mean, it goes from over 101 all the way down to call it 96 and some change. In fact, by 10:30, it got down to 95 handle. by 10:30 Eastern. I'm assuming that's Eastern time. And then look what it did. As soon as you get just a little bit of a decline, everyone and their grandmother, except the retail investor, comes in and starts buy, and brings it right back up to where it closes almost flat for the day. Closes only down 0.26. And let's go over to gold. And I would imagine it did the exact same thing. And I'm going to tell you why this is important in just a moment. Let's look at an intraday of gold. Yeah. Big sell-off, and then it just climbs right back up. So what's happening here? Everyone's buying the dip. It's buy the dip, buy the dip, buy the dip, buy the dip. And when you see a chart that looks like this, and you see this type of activity where even if it goes down like 1 or 2%, you almost immediately have buyers come in, hit the bid, and bring that thing right back to a level that's close to where it started the actual decline. So I'm not saying that this thing's going to go up. There are no certainties. There are only probabilities. But when you look at a chart like this, when you look at the intraday activity of not just gold, but the GDXJ, and then you think about the fact that what's driven this, let's just go to a 5-year chart. This is almost all central bank buying, and more recently, just investors or capital flowing into ETFs, gold ETFs, and therefore they have to go out there and buy. You guys know how those funds work. So dollar in, they have to buy $1 of gold, and so this has been the most recent run up in tandem with the central bank buying, but we still haven't had that retail investor participate. And in order for this to be a bubble that is likely going to burst, you have to have retail. Like, remember back in 2000, let's go all here. Remember this back in 2011, 2012? I mean, this was a retail mania when every single time you turned on the TV, what did you see? An ad, we buy gold, we buy gold, we buy gold. You just drive down the road and you'd see those guys like spinning the signs that we buy gold, we buy gold. You go into the mall, every single kiosk, we buy gold, we buy gold, we buy gold. And back then, I actually use a lot of my normie friends as contrarian indicators. I mean, I hate to say that, but your normie friends are great contrarian indicators. They just are. And so whenever you have all of your friends coming to you and say, hey, dude, I just bought a bar of gold, or I just bought some silver, and these are people that have never, ever, ever talked to you about precious metals before. That's what was happening back here, at least to me. I remember it vividly. So all these guys that I knew, all my good buddies that have never, ever, ever mentioned anything about precious metals, they're all out there going to the local gold dealer and buying. And back then, I would imagine the premiums were astronomical. This is the opposite of what we see today. Even though, look at that chart. Talk about parabolic. Jeez, look at this chart. And by the way, look at the last bull run. Started in about 2000. So it lasted, call it 10, 11 years. And with this bull run, I mean, you might say it started here. Even if you want to say that it started here, which I would say it started after it got to an all-time high in nominal terms in 2020. But looking at it from that standpoint, 2020, we're only 5 years into it. And even if you want to go back to 2018, which I don't know that I would, but going back to 2018, we're still only 7 years into it. And usually, as you can see right here, the last couple years of the bull market, until you get to the blow off top, is when the percentage gains are actually the most extreme. So I can't give you any investing advice, obviously, but what I can tell you is what I am doing with my own portfolio. And I own a lot of gold, especially now because it's gone up so much in price, but I haven't rebalanced my portfolio. I'm not really a big believer and rebalancing. But I did the other day sell a bit of my physical gold position to buy the GDXJ. So I was fortunate enough to do that a couple months ago when the GDXJ was trading about 68, and now it's obviously right around 100. So that was a good move, because even though gold has gone up during that time, the GDXJ has gone up to a much more significant degree, a much higher percentage. But personally, I'm not selling my gold. And if I did sell the gold, I'd only sell it just so I could buy more miners. And again, the reason why is because, is this a bubble? I mean, maybe, but in order for you to have that blow off top, you've got to have retail participate. You've got to have retail participate. And they're just not. They're net sellers right now. What's driven this price are central banks. It is capital flows into ETFs, which I wouldn't say those are your retail investors. I would say those are more your pension funds, your hedge funds, etc. Because a hedge fund isn't going to go out there and buy physical gold. At least most of them aren't. They're just going to buy the GLD, something like that. So I think that's really what you're seeing here. But to be clear, I have no problem selling not all my gold. I would never, ever, ever sell all my gold. But as far as the speculative gold position, or that's mostly the miners, I would have no problem selling that. I'm not married to any asset class. But I'm not personally, unless the chart really goes against me, I'm not going to be selling until I start seeing the cover of The Economist say gold is going to $10,000, or the cover of The Economist saying that the gold miners are the new Bitcoin or something like that, or the gold miners are the new crypto craze. Then I'm going to be like, maybe. And then I'm going to ask all my gold dealer friends. I say, hey, what are the premiums doing? And they're saying, oh my gosh, a few months ago they were at razor thin levels, but now they've just ballooned to levels that we haven't seen since 2011. Then I'm like, okay, now maybe it's time to scale back a little bit, assuming that the charts really don't go against me in the interim. All right, guys, on that bombshell, enjoy the rest of your evening. As always, make sure you are standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.